Welcome to Unraveling the Mind's Money Maze. Behavioral finance explores the influence of psychology on financial decisions. It delves into how emotions and cognitive biases can lead individuals astray from rational choices. Traditional finance assumes that people act rationally, maximizing their utility. Behavioral finance challenges this assumption, recognizing that human behavior is often driven by irrational impulses and cognitive shortcuts. By understanding these psychological influences, investors can gain valuable insights into market dynamics and their own decision-making processes. Behavioral finance provides a framework for recognizing and mitigating the impact of biases on financial choices. This field highlights the importance of psychological factors in shaping investment strategies and market trends. The study of behavioral finance has gained prominence in recent years. It offers a compelling alternative to traditional economic models. By acknowledging the role of emotions, biases, and heuristics, behavioral finance provides a more realistic and nuanced understanding of financial decision-making. Recognizing these psychological influences is crucial for improving financial literacy and promoting sound investment practices. In this section, we dive into emotions and biases, the hidden drivers of financial decisions. Emotions play a significant role in financial decision-making. Fear and greed, for instance, can cloud judgment and lead to impulsive actions. When faced with financial uncertainty, individuals may experience anxiety, leading to risk-averse behavior. Conversely, the allure of quick profits can trigger greed, prompting excessive risk-taking. Cognitive biases, systematic errors in thinking, further influence financial choices. These mental shortcuts, while often useful in everyday life, can lead to distorted perceptions and irrational decisions in financial contexts. Confirmation bias, overconfidence, and herd mentality are among the key biases impacting investors. Understanding these biases is crucial for making informed financial decisions. By recognizing the potential influence of emotions and biases, investors can take steps to mitigate their impact. Developing self-awareness and employing strategies to counteract these psychological pitfalls can significantly enhance financial decision-making. Next, let's explore confirmation bias, seeking evidence to support existing beliefs. Confirmation bias, a pervasive cognitive bias, refers to the tendency to favor information that confirms existing beliefs while dismissing contradictory evidence. This bias leads individuals to selectively seek out information that supports their preconceived notions, reinforcing their existing views. In financial decision-making, confirmation bias can have detrimental effects. Investors may cling to losing investments, ignoring signs of trouble, because they seek information validating their initial decision. They may also dismiss expert advice that contradicts their investment strategy, leading to poor choices. Overcoming confirmation bias requires actively seeking out diverse perspectives and critically evaluating information. Investors should challenge their assumptions and consider alternative viewpoints, even if they contradict their initial beliefs. By actively seeking out disconfirming evidence, individuals can mitigate the influence of confirmation bias on their financial decisions. Finally, we address overconfidence, inflated belief in one's abilities. Overconfidence, another prevalent cognitive bias, refers to an inflated belief in one's abilities and the accuracy of one's judgments. Individuals exhibiting overconfidence tend to overestimate their knowledge and skills, leading to excessive risk-taking and poor decision-making. In financial contexts, overconfidence can manifest in various ways. Investors may overestimate their ability to predict market movements, leading to frequent trading and higher transaction costs. They may also underestimate the risks associated with certain investments, leading to significant losses. Mitigating overconfidence requires acknowledging the limits of one's knowledge and recognizing the inherent uncertainty in financial markets. Seeking feedback from others, tracking investment performance, and diversifying portfolios can help counteract the effects of overconfidence. Section 5. Herd mentality, following the crowd, right or wrong. Herd mentality describes the tendency to follow the actions of a larger group, regardless of individual reasoning or evidence. This social phenomenon often stems from a desire to conform or a belief that the crowd possesses superior information. In financial markets, herd mentality can drive market bubbles and crashes. When a large number of investors follow a particular trend, it can create a self-reinforcing cycle of buying or selling, leading to inflated or depressed asset prices. Resisting herd mentality requires independent thinking and critical analysis. Investors should focus on their own investment goals and risk tolerance, rather than blindly following the crowd. Conducting thorough research, seeking expert advice, and avoiding emotional decision-making can help mitigate the influence of herd mentality. Section 6. Impact of biases. Real-life implications in finance. Behavioral biases have significant real-life implications in finance. They can affect investment decisions, market dynamics, and overall financial well-being. Understanding these biases is crucial for investors, financial professionals, and policymakers alike. Confirmation bias can lead investors to hold on to losing investments for too long, ignoring warning signs and hoping for a turnaround. This bias can also prevent investors from considering alternative investment strategies, leading to missed opportunities. Overconfidence can result in excessive trading, higher transaction costs, and concentrated portfolios, increasing the risk of substantial losses. Investors may overestimate their ability to time the market or pick winning stocks, leading to poor investment choices. Section 7. Confirmation bias in investing. Ignoring red flags. Confirmation bias can lead investors to ignore red flags and warning signs when evaluating investments. They may selectively focus on information that supports their initial investment thesis, dismissing evidence that contradicts their beliefs. For example, investors who have invested heavily in a particular company may overlook negative news reports or financial statements that suggest the company is struggling. They may rationalize away these red flags, seeking out information that confirms their belief in the company's future prospects. This selective attention can lead to poor investment decisions and substantial financial losses. Investors may hold on to losing investments for too long, hoping for a turnaround that never materializes. Overcoming confirmation bias requires actively seeking out and considering contradictory evidence, even if it challenges existing beliefs. Section 8. Overconfidence in trading. Excessive risk-taking. Overconfidence can fuel excessive risk-taking in trading. Investors who are overconfident in their abilities may engage in frequent trading, believing they can consistently predict market movements and generate superior returns. This overconfidence can lead to high transaction costs, eroding overall investment returns. Frequent trading often results in lower net profits, as investors incur trading fees and capital gains taxes. Additionally, overconfident traders may take on excessive leverage, amplifying potential losses. Mitigating overconfidence in trading requires acknowledging the inherent uncertainty of financial markets and recognizing the limits of one's predictive abilities. Developing a disciplined trading plan, setting realistic expectations, and seeking feedback from experienced traders can help counteract the effects of overconfidence. Section 9. Herd mentality in market bubbles. Riding the wave of speculation. Herd mentality can contribute to the formation of market bubbles. When a large number of investors follow a particular investment trend, it creates a self-reinforcing cycle of buying, driving asset prices up to unsustainable levels. As more investors join the bandwagon, driven by fear of missing out, or FOMO, the bubble expands further. However, bubbles are inherently fragile and eventually burst, leading to a sharp decline in asset prices. Investors caught in the bubble may experience significant losses as asset prices plummet. Resisting herd mentality requires independent thinking and critical analysis. Investors should focus on fundamental factors, such as company earnings and valuations, rather than speculative hype. Section 10. Enhancing financial well-being. Recognizing and overcoming biases. Recognizing and overcoming behavioral biases is crucial for enhancing financial well-being. By understanding the psychological factors that influence financial decision-making, individuals can make more informed choices and achieve their financial goals. Developing self-awareness is the first step towards mitigating biases. Individuals should reflect on their past financial decisions, identifying patterns of behavior that may indicate the influence of biases. Seeking feedback from trusted friends, family members, or financial advisors can provide valuable insights into potential blind spots. Educating oneself about common behavioral biases is also essential. Understanding the nature of these biases and their potential impact on financial decision-making can help individuals identify and counteract their influence. Section 11. Practical strategies. Steps to mitigate behavioral biases. Practical strategies can help individuals mitigate the influence of behavioral biases on their financial decisions. Implementing these strategies requires discipline, self-awareness, and a commitment to rational decision-making. One effective strategy is to establish clear financial goals and develop a comprehensive financial plan. This plan should outline investment objectives, risk tolerance, and asset allocation strategies. By adhering to a well-defined plan, individuals can reduce the likelihood of making impulsive decisions driven by emotions or biases. Another strategy is to seek out diverse perspectives and challenge existing beliefs. Consulting with financial advisors, reading analyses from reputable sources, and engaging in discussions with knowledgeable individuals can provide valuable insights and counteract confirmation bias. Section 12. Conclusion. Mastering your financial decisions. Mastering financial decisions requires understanding the interplay of rational and irrational factors that influence human behavior. Behavioral finance provides a framework for recognizing and mitigating the impact of emotions and cognitive biases on financial choices. By acknowledging the influence of confirmation bias, overconfidence, herd mentality, and other biases, individuals can develop strategies to counteract their effects. Developing self-awareness, seeking diverse perspectives, and adhering to a well-defined financial plan are crucial steps towards making sound financial decisions. Understanding behavioral finance empowers individuals to navigate the complexities of financial markets with greater clarity and control. By recognizing the psychological factors that can lead to suboptimal choices, individuals can make more informed decisions, enhance their financial well-being, and achieve their financial goals.